Hello guys. Hello guys. Can you hear me? Can you let me know in the chat if you can hear me? If everything works fine. And when I got that kind of info from you, then we can start. Yes. Okay, perfect. Perfect. So here we go. So yes, great. Sam, I'm glad you made it to this XMAS webinar, that you made time for this. It's an honor for me. And what I would like to talk about is a few questions I've got on eToro that were either hard to describe or explain them or answer them just via text on eToro, or I wanted to tell you more in detail about them. Then what I added in the webinar are another things I wanted to tell you about investing and about my strategy, and basically things I wanted to tell you after I read some questions you asked me, or I read some posts on eToro, and after I saw your concerns, what are you concerned about? So basically what we will be talking about are topics why I only invest in stocks, because I usually get questions why I do not invest in gold or bonds or real estate and stuff like that. Then the most important thing, most important topic will be how the market may look like after COVID. This is probably what we have came for in here. Then I will be talking about gold, because you guys keep asking about me about this investment. And then, of course, I can answer your questions. You dropped in the link in the video description on the Slido. I have already seen that you asked me a few questions. So after the presentation, I will go on these questions and go through all of them and answer all of them. So we can start. I can see there are 10 of us on the stream. Yesterday there were 200 people. Yesterday it was in Czech language. But I have more copies from Czech Republic, so it was expected like that. So let's go. The first topic I want to talk about is question why I only invest in stocks and nothing else. The reason is the stocks are the best performing assets and the least risky assets, and of course I will explain why. There is a graph from one professor at Wharton Business Schools, which is a very prestigious business school in the USA, in Pennsylvania, and he did a job of displaying returns of different asset classes like stocks, bonds, gold, or just cash in the period of last 200 years. And he also took into account inflation. So basically what we are looking at are real returns without inflation. So what we can see here is that US dollar is the worst performing one, which is it kind of expected, because it only loses its value when inflation, and usually we have inflation, and what I think there will be a lot of inflation in coming years. Gold is a little bit better, but nothing great. Bonds are better, much better, but what we can see here is that bonds were doing much better in historical years than than recently. Yeah, it is of course because there were much bigger interest rates than now, and what I expect in the near future, the interest rates will be kept low. So I think investing in bonds it's total nonsense. But on the other hand, low interest rates are good for stocks because companies can get cheap funding, cheap loans from banks, and they can use these loans to produce output, to do more investments, and to generate more revenues and more profit. So, at the end of the day, stocks has by far the greatest returns, which was kind of expected. But what is interesting in here is that we can see it has also smallest deviation of the prices against its trend. Yeah, it's this line. Yeah. So basically, we can say it has the lowest risk among all investment asset classes. And if you invest in cheap stocks, which is what I do, then the risk is almost zero. Yeah, because what you're doing when you are investing in stocks is that you are buying part of the company assets. Yeah, you are buying part of company's money in their bank accounts. You are buying part of their properties, yeah, part of their land, yeah, part of their patents, yeah, part of their know-how and IP, yeah. So if you are buying cheap stocks whose price on the stock exchange is very little above their book value, which is the sum of their assets, of their position, then the risk of losing money is basically totally minimal. Yeah, basically zero. Yeah, because if the company, of course, in short term, the price can get low under the book value. Yeah, book value is the sum of money of their assets. Yeah, so it's, for example, it's money on their bank accounts is the value of their properties, of their land, and so on. If you make sum of this, you get a book value. And if you buy stocks that are trading right above book value, then your risk of losing money is very small. Yeah, because the company cannot be traded under its book value, under its assets they have in possession in long term. Yeah. Of course, for example, cryptocurrencies does not give you this. Yeah, they does not give you part of company assets. Yeah, so if you're buying Bitcoin, for example, then your risk of losing money is high, because you basically do not buying any part of company assets. Yeah, for example, also investing in bonds is also much more riskier than investing in stocks, because monetary policy, for example, printing money, can ruin the bond yield. Yeah, because if there are more money in the economy and interest rates are small, then your return from bonds is small. Yeah, so monetary policy can ruin your bond yields. Yeah, that's why I'm interested in stocks. And also there is one thing, there is one mechanic that only works for stocks and nothing else. And the mechanics goes like this. businesses use labor, like people, and capital, like for example machines, to produce an output, yeah, to create goods that will be sold afterwards. The more equity is the money the business has on hands initially. The more equity business owns, the more labor or machines they can use, they can afford, and that's why they produces greater output and make greater profit that can be reinvested in even more labor and more machines next year, because from the profit they will make in next year they can buy new machines and employ new people, and the year after that's why they can create more goods and sell more goods and make more profit the year after. Yeah. So I should probably turn off the camera so that you can see that. Yes. So in year 1, or let's say in year 0, you have a business has $1 million on their hands, and they are able to make return on equity 10%. I usually do not invest in companies whose return on equity is lower than 10%. So after 1 year, their equity at the end of the year is 1,100,000. Yeah, because 10% profit on the 1 million. And at the beginning of the year 2, their equity is 1,100,000, and again, if they can create profit, 10% profit, then at the end of the year 2, it's this number, yeah, and so on and so on. So after 6 years, so let's say 7 or 8 years, the return on equity is double, yeah, only because of that fact that they can reinvest the profit from the last year into next year and buy new labor and new machines, yeah. And this mechanics only work for stocks, and this is the reason why stocks is the best investment, yeah. So let's switch to the second topic, and that's what are most important tasks for an investor. Investor has two really important tasks, and first of them is to prepare his portfolio for any scenario that can happen in future, yeah. Because stock exchange or stock market is a place where there are a lot of uncertainties, a lot of risk, a lot of question marks, and a lot of things that we even do not know that poses a risk, or yeah, there are a lot of uncertainties, yeah, on stock market. So basically, your portfolio must be prepared for any scenario or any outcome in future that can happen, and not just one. What I can see at the other popular investors is that they will expect one result in future, one specific result in future, and they will create a portfolio that take this one outcome into consideration, and in this specific outcome the portfolio performs well, but under other circumstances, under other scenarios, their portfolio will perform very badly. which is wrong. Yeah, because as you can see, for example, here on this graph, even if they consider the most probable scenario in future, which is this one, and it has probability of 0.4, then sum of probabilities of other scenarios that can happen is bigger than 0.4, yeah, because it is integral from here and plus integral from here, yeah. Yeah, so what a good investor does is that he creates the portfolio that will perform good under different scenarios that can happen in future. Yeah, this is extremely important. Yeah, and the second thing that a good investor must be doing is that he must balance offense and defense according to current situation that is going on the market. And what I mean by balancing offense and defense, or what I mean by defense and offense and defense. Offense are stocks that are going for the best performance, the best yield, yeah, but under high risk. And defense are stocks that performs quite poor in terms of percentage, in terms of returns, but they are safe. Yeah? They are not risky. And we know what they are. Yeah? For example, offense is holding no cash, defense is holding a lot of cash in the account. Yeah? And wait for the, for example, market crash, and then buy stocks at a discount at very cheap levels for the cash that they had been holding. Offense is investing in growth stocks. Yeah, growth companies are companies that are quite innovative, that they make zero profit. Yeah, they are making losses, but their revenues are growing very quickly. And on the other hand, defense are value stocks. Yeah, value stocks are stocks that make profit, make steady profit. Their profit is growing, but not quickly. Yeah, but they are very traditional, big, and popular companies, and investing in them is safe. Yeah, for example, groceries. Yeah, and companies like that, yeah, or pharma companies, yeah. Offense are cyclical stocks, yeah. Cyclical stocks are stocks whose big part of revenues are made in one specific time in a year, yeah. For example, FedEx or UPS has a lot of revenues before Christmas, yeah, because people are buying Christmas gifts, and yeah, and FedEx or UPS is shipping them. Yeah, these companies perform very good when there is an economic boom, but they perform very badly where there is a recession. Yeah, they are highly correlated with GDP. On the other hand, defense stocks are structural, yeah, so that's opposite, yeah. No matter period of the year, their revenues are steady, yeah. Offense are investing in emerging markets, yeah, for example, Africa or Latin America, yeah. Defense is investing in US or Europe. Offense is investing in small companies or mid companies. Defense is investing in big companies. Yeah. And what I'm trying to say is that I have no problem having portfolio that consists only of growth stocks with no cash, which is totally 100% offense, in few specific times, but definitely not now. Yeah, because currently there are a lot of things, a lot of question marks we know nothing about in future. Yeah, so we definitely should be on the defense side right now. Yeah, we don't know when most people get vaccinated. We don't know how many lockdowns will be imposed by then. We don't know if people even want the vaccine or will want the vaccine. We don't know what the oil price will be, yeah, which is very important because oil price, when you are running a company, oil price determines your costs level, yeah, because a lot of costs you have to pay depend on oil price, yeah. For example, transportation, yeah, depends on oil price, yeah, because of gasoline, yeah. Yeah, or also some production things also depend on oil price, yeah. Oil price also determines how big inflation there will be in future, and level of inflation determines if growth stocks outperform value stocks or vice versa, yeah. Yeah, because if oil price is big, then you have to, as a businessman, you have to increase prices. Yeah, so it leads to bigger inflation. Yeah. We do not know if investors stop pouring money into index funds, which is also very big question marks. Yeah. Now in America, almost 90% of money are invested in index funds, no matter the price of the stocks that are components of the index. But when people start liquidating these returns, yeah, when people start selling the indices, yeah, for example Nasdaq, yeah, this year people who bought Nasdaq in spring or summer, they already made a very good return, so they can sell the Nasdaq soon. Yeah, if people did this in future, then you must be aware that on the transaction of the selling the index, there must be two parts. Yeah, there must be seller and there must be buyer. And yeah, if people are gonna sell the Nasdaq, they are the sellers, but who will be the buyers? The buyers must be the active investors who buy stocks only with a consideration to price. Yeah, they buy stocks only at a good price. So they will not be buying, for example, Facebook or Netflix or Microsoft if the price will be, I don't know, 20% lower, because it's still too a lot for them. Yeah. So if people will want to start selling Nasdaq, and the big components of Nasdaq are Facebook, Microsoft, Apple, Amazon, these overpriced companies, then they must have someone who will buy it from them, and the one who will buy it from them will not buy it at prices that are 20% lower now, because it's still too much for them. They will have to buy it. They will buy it for half, for example. Yeah, this is what happened at the end of the year 2018, where it was in December. The market crashed like 30%. Yeah, and basically nobody knew why it happened, but it was exactly because of this. Yeah, because in America there is already a lot of too much money invested in index funds passively and too little money invested actively. Yeah, and when people started to selling the indices and liquidating the index funds at the end of 2018, they had no buyers. Yeah, so the price was declining very quickly. Yeah, and it resulted in a crash of 30%. Yeah, so these things we do not know at the moment, and these are very serious. So now I think, or I definitely think that we should be on the defense side, more on the defense side. Yeah, that's why my portfolio now is not performing as good as, for example, the other popular investors, because the other popular investors are going for 100% offense and zero defense. Yeah, they are doing almost 100% growth stocks, and they are holding almost no cash. Yeah, which is under current circumstances and according to my opinion, in my opinion, very bad strategy. Let's switch to new chapter. I will go through the chat very quickly. There is something I should respond. Yes, Hannes, I will answer this question at the end of the presentation. Yes, of course. Okay, so new chapter. Maybe guys, if you don't mind, from time to time, just drop me a line if everything works fine, if the connections is fine. Yeah, you know, I'm streaming from the USA and on quite bad upload, so of course I'm afraid if everything is fine. Yeah, okay. So let's switch to new chapter. So what to expect after the COVID is gone? Definitely we should expect recession in US, Europe, and Latin America, because the shock into economy was too big in these countries. Yeah, there were a lot of COVID cases, which resulted in a lot of lockdowns and a lot of restrictions, which will definitely result in a recession in the US and Europe. On the other hand, I think Asian countries could be a very good place to invest in next year. And I have already started to do research among Asian companies, and I'm trying to find Asian companies to invest in as soon as possible, because in Asia the shock into economy wasn't as big as in Europe and US. Yeah, basically Asian countries addressed or cope with the virus very quickly, handled the virus very quickly, with almost no lockdowns, almost no restrictions. Yeah, so what I think and in Asian countries, for example, for example, Taiwan or South Korea or Singapore, yeah, the life over there is pretty normal. Yeah, and economy works fine, very fine. There are basically no restrictions at the moment. So I think Asian countries will be the winners of the COVID crisis, and that's where I'm trying to find new opportunities to invest in right now. Next point, as interest rates will remain low, and they will remain low because that's the most effective way of central banks how to keep the economy alive, how to keep it afloat. So as the interest rates will remain low, stocks will definitely outperform bonds heavily, because with low interest rates and high inflation, which is what I expect in the future, that will be under low interest rates and high inflation, the real return from bonds will be basically negative. Yeah. But on the other hand, it's very good for stocks, as we have already talked about. Big inflation in US and Europe due to monetary and fiscal policy, as now more money are in the US and Europe economy now, which is kind of obvious. That's why also US and Euro is going to weaken against other major currencies. And I will probably add some currency hedging in my portfolio because of that, because at the end of the day, I hold a lot of US stocks. And US dollar is going to weaken, is about to weaken against other major currencies, because there are more dollars in the economy, basically, which means that dollar is less valuable now. Less valuable than, for example, I don't know, Czech crowns, because in our country the printing money wasn't so big as in USA. And what's very interesting to know is what inflation causes on the stock market if we are going into period of big inflation. And by big inflation, I mean, for example, 7% per year, which is what I expect that will be in next years. Yeah, so that's what I mean, big inflation. Under periods of big inflation, value stocks perform much better than growth stocks. The reason, give a second, I'm looking at the chat. Okay, things should be fine, and I'll take a sip. Give a second. Yep. So, in the period of big inflation, let's say 7%, value stocks outperform growth stocks. And the reason why is that during inflation, real debt is cheaper, which means that in the period of big inflation, it's good to owe money, because if I get a loan for $100,000 and there is a 10% inflation, and let's say I will get it at a 0 interest rate, then after the year, my real debt is 10% lower. So during inflation, the real debt, is cheaper, and banks prefer value stocks than growth stocks in giving loans. So what I mean that banks are willing to give loans to value companies, more willing to give it to them than to growth companies, which results in the fact that value stocks can grow more rapidly, because they can afford more labor and more machines, so they can produce bigger output that will sell afterwards, and they will make bigger profit than growth. And the reason why banks are willing to give a loan to value companies more, preferably over growth companies, is that, first of all, because value stocks or their products is much more essential than growth stocks. Yeah, if you are selling groceries or pharmacy, medicines, then of course your product is much more essential than, for example, buying a Tesla. Maybe you need to buy a car, but still you can, if you are in a recession and if you are forced to tighten your belt, then you will probably buy a cheaper car than Tesla. So banks definitely prefer value stocks over value companies over growth companies in giving loans. The second reason is that value companies already make steady profit, and on the other hand, growth companies do not make any profit. They make losses. And in the period of inflation, value have even bigger profits, while growth make even bigger losses, because in the period of inflation you have bigger revenues and you have bigger costs. And if you are making profit, then your profit is bigger. But if you are not making profit, if you are making losses, then your loss is bigger. Basically. There is a graph that demonstrates what I have said. It's pretty obvious because the line is pretty obvious that in the periods of big inflation, value companies outperformed growth companies. Most notably year 1970, which I will be talking about in next slides, which is very important for us. Because what happened at this year was very similar environment than the current one. So let's go for it. Let's switch to that. What happened in history? Of course, we cannot replicate current situation like totally, but there were two similar cases in history that were pretty similar than current situation on the market. There was the dot-com bubble, which you probably heard of. It was like a beginning of 2000 here, and there was belief that investing in internet companies will make you a fortune, and because internet will be the future, or would be the future, and investing in internet companies will make you rich. Problem is that first part of the sentence is true. Internet did change the world. But the second part is definitely not true, because the companies who made money on the internet thing, and are very few of them. And if you invested if you invested your money in internet companies, there are only very few of them that would make you rich. Most of the internet companies will let you end up with zero money, will let you lose basically all your money. What is interesting is that current valuations of tech companies are even higher than the valuations were that time. And of course, the high valuations was the reason why the market crashed, and Nasdaq crashed almost 80% very, very quickly. there was a belief that those companies will be market leaders forever, and if you invest in your money in, for example, Yahoo or Nokia or Sony, then you cannot be false, and that you will definitely be very rich, because there was a belief that Yahoo, Nokia, and Sony will be market leaders forever. We can ask yourselves where Nokia is. That time Nokia had like 92% of market share with cell phones. Yahoo was definitely the leader among search engines. They had bigger market share than Google at that time. So this is one similar period of time in history that was pretty similar to the current one, because today, everything invests in tech companies at very high valuations. They are extremely overpriced tech stocks that do not make any profit. It's completely the same like it was during the dot-com bubble. But honestly, today, it's even worse than that time. Today, valuations are worse than that time. And that time, Nasdaq crashed 80%. But there's also another period in history which is even more interesting, because it is even more similar to the current one that the dot-com bubble. It's a period that is called Nifty 50, and it took place like 1970 or so. And this period was featured by extremely overpriced best companies. By best companies, I mean companies that were really market leaders in everything. There were big companies, there were steady companies. It was companies like Coca-Cola, Walmart, Disney, and other companies that today basically do not exist, but at that time were market leaders. For example, Kodak, Xerox, Polaroid. And there was belief that investing in these companies again will make you a fortune. And by investing in these companies, there was a belief that by investing in these companies, you cannot be false. You cannot be false. Because it's 100% sure that if you invest in these 50 companies, then you cannot be false, and you only can make money and not lose money at all. Because there was a belief that Kodak will be market leader forever, because Kodak had like 90% market share in cameras. There was a belief that Xerox or Polaroids will be again market leaders and will be best companies. And investing in those 50 companies very quickly lost all the money to their investors, basically all their money. People who invested in those 50 companies within 3 weeks lost basically half of their money, and after a period of another like 3 years where there was a steady market decline, they lost basically all their money. What is interesting is that the more you invested in more expensive stocks, then your loss was bigger. Which means that the prices really matter. Because here the graph is pretty obvious. Yeah, the higher the PE, and by expensiveness of the stocks was measured by PE, the higher the PE, the bigger the subsequent loss was for the investors who invested in the Nifty 50 companies. Yeah, and again, it was period when value stocks are heavily outperformed growth stocks. What is interesting that it was period of big inflation, which I expect that will be next year and next years. It was period of great governmental spending, like now. It was period when US dollar was devaluated by 7% against other major currencies, which again I expect that will happen next year. And it was period of high unemployment, which again is expected next year. So we should definitely look at those cases, those case studies that happened in history, and take this lesson into creating the portfolio. Again, before switching to another chapter, I will look at the chat. Sound. What does it mean, sound? Sound is not working, or what? How long is your average stock holdings? I usually hold stocks for like 2 years, but at this current period of time it's shorter because I have to be reactive. It's working fine, thank you. Sound is good. Because at the current situation, when everything is changing pretty fast, my holdings is usually shorter because I'm trying to react to what is going on the market. Oh, all good, fine, okay. So let's go to another chapter. People ask me why I am trying to avoid crashes or avoid declines or drawdowns in my portfolio, and I'm not aiming for big returns, because even if people ask me why I'm trying to avoid crashes, and I'm willing to give away some returns than aiming for big returns with potential big losses. Yeah, and the reason is this one. During last 20 years, Nasdaq rose like 20 times. But if you managed to avoid crashes, your performance would be 410x in the same period or so. Yeah, this is the reason. Yeah, when you lose 50%, you must gain 100% to break even afterwards. So small drawdown with small gains is better than big drawdown and big gains. Yeah, growth stocks falls much more in recessions because growth stocks are not as essential as value stocks. Yeah, because if there is a recession and you are afraid of losing your job, then you will not buy a Tesla. You will buy a cheaper car. Yeah, but you will have to buy food. Yeah, you will have to buy, I don't know, meds. Yeah, so when I expect recession, I'm not roaring into growth stocks, yeah, because it's nonsense, yeah. If I expect recession, then I'm going for value stocks, yeah, like groceries, yeah, for example. And yeah, recession expected in next year and probably the year after, yeah. The avoiding crashes is the main reason why Buffett is the richest man, yeah, because Buffett was able to minimize the losses, yeah. Yes, of course, when there was a market crash of 30%, his Berkshire Hathaway also was in downturn, yeah, but not as big as market, yeah. This is the reason why Buffett is the most richest man, yeah, because Buffett made some losses, but when the market was going down heavily, but not as big as the market, yeah. This is the reason, yeah. And another thing why best investors, including Buffett, are underperforming the market right now, and it is completely fine, is that if you wanted to keep up with the market or even outperform it, you would have to buy stocks that are the biggest components of the market. Yeah? So for example, you would have to buy, or you would have to have a lot of Facebook, Amazon, Apple, Google, Netflix, and these heavily overpriced companies and heavily risky companies. You would have to have a lot of these in your portfolio in order to keep up with the market or in order to outperform the market. And the good investors like Buffett or like David Einhorn or like hopefully me are aware of the fact that this is extremely risky and this is not good, yeah. Because at the end of the day, the best investors like Einhorn and Buffett has still much better performance than the market, but it is over a period of last 20 or 30 years, yeah. But in the period of recent, like last 5 years, like yes, let's say in the period of last 5 years, those best investors heavily underperform the market, and it is totally fine, yeah. So our strategy for the next year or let's say future. As I already said, I will want to add in more Asian stocks. Yeah. This is what I'm trying to do now. Yeah. Then I will also want to hold value stocks that sell essential goods like grocery, medicine, yeah, or companies whose revenues are made of governmental mandatory expenditures like Lockheed Martin, for example. Yeah, most of the Lockheed Martin, it's a company, it's an arm company. Yeah, so they are creating weapons. And they sell it mostly to the U.S. government. Yeah, most of the Lockheed Martin's revenues are mandatory expenditures, government mandatory expenditures by U.S. government. Yeah, so basically, even if there was a recession and people will start to save money, and they will start to stop, or they will start to buying more essential goods and not the luxury goods, then still Lockheed Martin is fine, because even if people start to save money, then their revenues will not decline, because most of their revenues are government mandatory expenditures that the government must pay year over year. When US and European economy starts to getting into shape, starts to rebound, we will start buying a lot of cyclicals. Yeah, so companies like car manufacturers, companies like FedEx, banks, maybe even few airlines, because these companies rebounds very quickly and much more than the market when there is an obvious market rebound and economy goes into boom, turns into boom. And we will also start to buy more mid caps or maybe even small caps companies, instead of the large companies, to outperform the market. Yeah, there is a pretty obvious graph that mid-cap companies tend to outperform the market after recession. Yeah, it's pretty obvious because small and mid-cap companies are more flexible than the bigger ones. So when the economic environment starts to change, then the small companies or mid-sized companies can address the market needs more quickly and are one step behind the large companies in their product. So basically, that's everything from me, everything from what I wanted to tell you about. And then basically now we can switch to Q&A. Of course, if you are interested in more webinars like this or more videos about investing, then you can subscribe my channel and hit the notification bell button, because I want to upload like one video every 2 weeks or so about investing, because there are a lot of interesting things in the and a lot of interesting topics in the investing and finance field that I will want to make a video about. So if you are interested in these, then you can subscribe this channel, and of course you can copy my portfolio on eToro, and that's it. So we can change to Q&A. How do you find your short position? Is mainly technicals or fundamentals? If fundamentals, how do you come to the conclusion to short based on what? Okay, my decision about investing is always fundamental. I do not use technical analysis at all. When I decide to invest in a company, I will try to find its value. That means what price it should be traded on a stock exchange. Yeah, and how I do that. I will read a lot of annual reports about it. I will read a lot of news about it, and I will look at their assets. Yeah, for example, how much money they have in their bank accounts, how much property and land they owned, because of course, if a company has $1 million or $1 billion in their bank account, it definitely has its value. So this is one thing I look at, and this is called book value. And then I will look at its ability to make profit. Yeah, so I will look at their profit and loss statements in many years and many periods or quarters, like in the last 10 years, and I will determine its ability to make profits also in the future. And some kind of markup of this ability to make profits, markup on the book value, is the value of the company. Yeah? So it's a sum of its assets, of its possessions, and of its ability to make profit in future. This is the value of the company according to me, according to my view. And then I will look at its price, how it is traded on a stock exchange. If the price is, if there is a big discrepancy between my value and between the price on a stock exchange, then I will invest. On the long side, if the price on the stock exchange is way below the value or the number that I consider as value of the company, then I will invest on the long side. If it is on the reverse, like the price on the stock exchange is way higher than the value according to my view, then I will decide to open the short. And I can see I've already responded the second question, because it was the same thing on the other side. Another question. Would you be up for a seminar on how do you do the stock valuation? I know that might be kind of individual, but would be intriguing. Respect for your knowledge, sir. Yes, thank you so much for that. And of course, yeah, we can do that. We can do that. Yes, let's do this. Do you consider to buy 𝗪𝗛𝗘𝗡 company, which might be familiar to you because of its holding of Vatava fund? I do not know. I invest in companies that I know basically everything about, and I feel free to invest because I think I know everything about them. And 𝗪𝗛𝗘𝗡 is not a company I know everything about them yet. So I do not want to invest in it now. Your portfolio currently performs poorly. I don't think so, but okay. The reason is your timing with shorts. Will you optimize this? Basically, there is no way how to optimize this. You cannot time the market. I'm doing my best, of course, to open the shorts at the best time possible, but I know my timing wasn't very fine recently, but I think there is nothing you can do about timing a market. Stock exchange is a place with a lot of uncertainties, a lot of question marks, and you do not know what will happen on the stock market tomorrow and the day after. You cannot time the market. It was pretty bad luck. What do you think about regulatory issues of Alibaba? Do you find the reaction of the market reasonable? What is your mid and long-term outlook of Alibaba? I do not think this poses any risk. It is great because it allowed us to buy Alibaba at a good price. My mid and long-term outlook on Alibaba is basically great because, as I said, it's a stock that is in Asia, first of all. It is a stock that is selling quite underdog product. So it means that if we are coming into recession and people will start to tightening their belt and start to save money and will start to switch to more cheaper goods than, for example, from Amazon, then Alibaba, it's a great place to go. And it's also an online company, which is great because we do not know how offline will perform in the next let's say 6 months until or by the time a lot of people are vaccinated. Yeah, there can be more lockdowns. Yeah, the virus is not under control. Yeah, so yeah, so my view on Alibaba, it's very fine, it's good and up and coming, and yeah, that's why I bought quite a lot of this stock. That's everything from the Q&A, but I can see I forgot about goal. So let's also talk about goal for a second. And again, I will check up on the chat. What about stuff like utility companies? I do not invest in utility companies. It's because they are selling a product that has no competitive advantage over another companies, and I basically only invest in companies that has some kind of competitive advantage. Yeah, when you are buying electricity or utilities at all, then the only thing you care about is price, and the utility companies must lower the price in order to keep competitive. And this is not kind of business I'm looking for. I'm looking for a business that have competitive advantage and that do not have to lower the price in order to keep their market share. Yeah, this is the most important thing for me. Yeah, because if you are in a business when you have to lower prices in order to keep competitive, then you are cutting your margins, and you can easily end up with a very small margin in order to keep your market share, which is not what I'm looking for. Yeah, of course I know that utility companies sometimes have some kind of monopoly on a local market, but still it is not kind of product I'm looking for. Yeah. Thank you. Okay, thank you. So let's switch to goal. Goal at the moment is able to create zero cash flow, in a sense that their incomes are basically the same as their expenditures. Yeah, and I'm talking about cash flow, not about earnings. Yeah, because in earnings you have I need to show something. Give me a second. I have to show something. In earnings you have depreciation. Yeah, so goal can make a loss in terms of earnings because their depreciation on the planes is quite high, but still they do not have to lose money from their bank account, because the income they make from selling tickets is more or less the same than their expenditures are now at the moment. Yeah, so they are not making losses. That's I mean, from cash flow point of view. From earnings point of view, they are making losses. Yeah. What is important now? Even though they do not make a loss, they are in a serious trouble, because the money they have on their bank accounts is like everything that they can turn into cash. It's like 5 billion Brazilian reals. Yeah, the currency in here is Brazilian reals, which is $1 is like 5 Brazilian reals. Out of the 5 billion, 2 billion are deposit. Yeah, that means that they are already advanced ticket sales. Yeah, so basically we can deduct this number, because they still have to either refund those tickets or they will have to pay the costs of making those flights. Yeah. So basically they have something like 3 billion in cash liquidity on their hands, but what they have to pay this year is 12 billion. And what they have to pay in next years is 15 billion. Of course, they can postpone some payments. Yeah, for example, some leases, some, I don't know, aircrafts, fees. They can postpone a few payments, but definitely not all of them, and definitely not a big part of them, because all the companies they owe money to, for example, banks or other aircraft companies, are now in a serious trouble, and they need money too. Yeah, so they will not be willing to comply with goal and let them postpone everything. Yeah, because they know their debt burden is too high. Yeah, they have something like 3 billion cash on hand, and they have to pay liabilities of 12 billion in this year. It do not necessarily be by the end of this year. Yeah? It can be like a fiscal year. Yeah, but let's say in the next 12 months, and 15 billion afterwards in, let's say, over a period of next 5 years. Yeah. So what I think, and I'm totally sure about it, is that this situation must result in a board meeting that will end up with new stock issuance, because if they issue new stocks, they can pay for some part of their debt, or they will have to apply for a protection against its creditors. Yeah, both of these actions will result in a serious stock price decline. Yeah, that's pretty obvious. Yeah, so this is the situation Goal is in at the moment. Yeah, basically they are in a really serious trouble. Yeah, they cannot. They for example, mileage program. They already collected money from a mileage program in the amount of 1 billion, and advanced ticket sales almost 2 billion. They cannot tell the people they would not give them their money back, or they cannot force them to postpone the refunds on the tickets over and over again. Yeah, if they did this, then the people will end up pissed off with them. Yeah, so yeah, I cannot see under current circumstances, I cannot see any other option for Goal than issuance of new stocks or protections against their creditors, low protection, which both has to result in a price stocks decline, because if you have more stocks if you have more stocks in the economy, then they are less valuable. Yeah, so the price will go lower significantly, and they will have to issue a significant number of shares. Yeah, in order to pay off some of their debts. Basically, it's only a matter of time. Yeah, it can, of course, take few months. Maybe it can take a year, but it's only a matter of time. Yeah. Yeah. So basically everything. That's basically everything from me. I scan the chat again if there is something turned up. Yeah, guys, yeah. Even Lufthansa didn't refund. Yep. Yeah, airlines are in a serious shit right now. Yeah. That's also another reason behind I opened the short against Goal, yeah, because Goal wasn't able to make a profit even before the pandemic, yeah, even in the pre-pandemic levels, yeah, they weren't able to make a profit. They were able to make a positive cash flow, but they weren't able to make a profit with the depreciation. Yeah, I can show, or no, it doesn't matter. What I'm trying to say is that they weren't even able to make a profit before the pandemic, and now after pandemic, when the airline situation will be much worse, it will be even much harder for them. Yeah, because first of all, they bear much more debt, yeah, so they have to pay much more interest on that, which of course leads to fact they are forced to increase prices of their flight tickets, which means that people will be less interested in buying them. On top of that, people will be less interested in buying flight tickets at all, because it's a luxury product, yeah, and people probably may have to start to save money, yeah, so people will not be buying flight tickets like crazy, yeah. In terms of the business trips, again, this is something that will be cut after the pandemic, yeah, because first of all, it's expensive. Second of all, it will take a lot of time, for example, 2 business days or 3 business days to a manager to go somewhere and back, to travel back and forth, just to make an appointment that will last like an hour, yeah. A lot of businesses will be switching to video conferences, yeah, like Zoom, for example, yeah. I'm not saying all businesses will be switching to online video conferencing tools like Zoom, but some of them, which means that Goal will again find itself in a much harder, much more difficult situation how to attract its customers, yeah. There are more things like that. There can be a new airline that will enter the Latin America market, which is very interesting. Yeah, since there are plenty of planes that are grounded and unleased, the lease payments for leasing an aircraft is going down like significantly. So if you want to lease a plane, it's much cheaper now than it was before. So basically, if you want to enter the Latin American market as a new airline, you can be leasing new planes much more cheaply. You will not pay any big interest on very big debt like Goal has to pay. So basically, you will be able to offer much cheaper flight tickets than Goal, and you will be able to eat out Goal from the market. Yeah. So this is another thing that I'm not sure that will happen, but that can happen. Yeah. So yeah. So that's why I decided to open Goal, and I wanted to show you the numbers. Yeah, because because maybe you haven't seen them, and yeah, I wanted to show you how big trouble gold is in at the moment. Yeah, so I'm pretty comfortable with the investment. Moreover, it's a great hedge against any market downturn, against any recession that might occur next year. Yeah, because airlines are heavily correlated with the market, and in terms of gold, it's beta. It is like 2 or 3, which means that if market goes down, then the goal goes down 3 times more. Yeah, so this is the main reason why I open gold, basically, to hedge against any market downturns. It works fine for us. Yeah, but you were concerned about this investment, so I definitely wanted to feature it in this webinar and talk about it. Yeah, so I think that's it. I cannot see any new questions in the chat, so I think we can close this webinar. We can quit, we can end it, and yeah, so Merry Christmas, Happy New Year, and see you next year. Yeah, and if you like this, just drop me a line, let me know, maybe in the comments below the video, and we can do this more often if you find this interesting. And yeah, that's it. So thank you for your time, and if everything turns up, just let me know, and I will do my best to answer your questions as soon as possible. See you. Bye.